In this video, I'll explain the difference between crypto futures and crypto perpetual futures, otherwise known as perps, what the difference is here and why would you want to trade one versus the other. So we'll go over everything. I'll leave timestamps in the description below as well if you want to skip around. So firstly, we need to explain what futures are. So usually when you trade any asset, not just crypto, but any asset, you trade in the spot market, which is a cash settled market. So if I want to buy Bitcoin, I go into the spot market, I exchange dollars for Bitcoin, and that exchange happens immediately. That is a physical transaction. And so I then receive the Bitcoin, and that's my property. And I can withdraw it from the platform, right? It's my asset. So with futures, these are derivatives, which means they are a product of the spot market. So when we trade in the derivatives market, like futures or perpetual futures, what we're actually trading is a synthetic contract based on the price of something else, because it's a derivative of something else, right? So Bitcoin USDT is a spot market, right, where you can physically exchange dollars for Bitcoin, and that has a price. Now in the futures market, what you're doing is trading some expected outcome in the future. And so the derivatives market is literally a market of people buying and selling prices. So it's a contract between a buyer and a seller to exchange the value of that contract when they trade. And you open a position, and then later on you close a position. You never own the Bitcoin or any other asset. You never own the Bitcoin, you never trade the Bitcoin. You're simply trading the price of the asset. And so this allows us to do a few different things. You can go long, which is where you benefit from the price going up. You can go short, where you benefit from the price going down. And that's like selling, but of course, you don't sell anything because you're not buying and selling the asset. That's why we say long and short, because we're not actually buying the asset, we're just trading the price. So with a derivative, what you're doing is trading the price of the asset, and you open a position and you close a position. And when you open and close, you either have a profit or you have a loss. When we trade derivatives and futures, we don't actually exchange any assets. The only time we settle our balance is when we close our trade. So we open the trade with the platform and we take the other side of another trader, and that's our open trade. Now, when we close our trade, we have to settle the balance. If we made a profit, we get the balance from someone else. If we made a loss, we have to pay to close a trade, pay for the loss, right? So when trading futures, you don't actually exchange any assets when you open the trade. You're just simply cash settling profits and losses between other traders. So to trade futures, what we do is we put collateral into our account. Just think of this as cash, right? So unlike spot, where if you want to buy $1,000 of Bitcoin, you have to have $1,000, you exchange that $1,000, you get the Bitcoin. It's not the same in futures or perpetual futures. All you do is put cash on the system, and that is there to pay for potential losses in your trades in the future. So that collateral, for the most part, is dollars, right? Stable coins, USDT or USDC. But you can also put coin on these platforms as well, like Bitcoin, ETH, other assets, because they have a value as well. Now, what's going to happen is you give this to the trading platform, and that is there as collateral to pay for potential losses in your trades in the future. And you only exchange that if you make a loss, right? If you make a profit, then the other side of the trade will obviously be putting that cash into your account. So you have collateral to pay for trades, and you only exchange when you close trades. So that collateral is there. Now with futures, you can trade with leverage, which is more than the value of your collateral. The reason being is that the exchange doesn't really care what you do, and it doesn't care how big your trade is or anything else. The only thing they care about is that you can pay for potential losses in your trades. So with trading with leverage, let's say you have $1,000 of cash, you can open a $10,000 trade if you want, right? And the reason is that you have $1,000 to pay for a potential loss in that trade. So you can open a $10,000 trade with $1,000 cash. Now, obviously, if the $10,000 trade loses 10%, your cash, therefore, can't pay for any more losses, so you get liquidated, which means that cash is just used to pay off the trade is closed for you. So trading with leverage is something you can do with perps and expiry date futures, because you're just simply opening a trade of an amount, and as long as you can pay for the loss, that trade will remain open. So what you can see here on any trading system, I'm on Bybit here, so trade, futures, and we're just looking at perpetuals for now. So you can go ahead and open a trade of anything that you want. As long as you can pay for the loss, you can open the trade. And of course, if you do make a loss, then your cash will go out to pay for that trade. If you want to trade on Bybit or some of the other crypto platforms I use, I'll link them in the description. You can get some great deposit and trading bonuses via those links. So you can have a look when you're watching this video. So as you can see here, there is up in the top right of every crypto trading platform, there is a way to take leverage. So I'm going to press customize here. Now leverage is, let's say I've got $1,000. I can trade with much more than that. So I can open a $3,000 trade with 3x leverage, right? So 3x leverage is 3 times my cash. So a $3,000 trade in relation to $1,000 cash is 3x leverage. Alternatively, you can say, let's say you have $1,000 and you want to trade 3x leverage, you want to open a $1,000 trade. Well, you're going to put $333 cash down to fund that. 3x leverage is the trade size in relation to how much cash that you have down. So you can trade with leverage, or you can just go to 1, right? Which is, if you have $1,000 trade, you put $1,000 cash tied up into that trade to fund that position. So very different to spot. With both perps and expiry date futures, this is how you trade it. You put cash onto trade. You can then trade an amount that can be more than the cash that you have or less than the cash that you have. You can take leverage. And then of course, with leverage, the profit and loss calculation becomes different, right? So if you have very high leverage, so I've got $1,000 cash and a $10,000 position. If that $10,000 position falls 10%, I get liquidated. So that's obviously very risky. With, let's say, 2x leverage, I have $1,000 in the account, I open a $2,000 trade. Well, now I've got $1,000 cash to pay for that trade, so I can withstand a 50% loss before my cash gets liquidated. Now I'll come to the main difference between perps and expiry date futures, and the clues in the name. Perps are perpetual. There is no expiry date to this contract. And so we are basically trading the spot price of Bitcoin USD very closely, just in a synthetic contract. And with expiry date futures, there is an expiry date. And so we are trading what we think the price is going to be on that expiry date. So if I go to futures here, you can see that the markets are all different dependent on the expiry date of that contract. So this is the, let's say, choose this one, 26th of June, 2026. You can see this is when the contract opened. And this is obviously throughout the contract so far, the price has gone down. What traders are trading here is, what is the price going to be on the 26th of June? Now, as the spot market comes down in price, it's much less likely that the price of the June expiry is going to be very high. And so the price of this contract also falls. As Bitcoin has recently recovered, the chance of the price on the 26th of June being higher goes up, and therefore this contract trades up as well. There is an expiry here. Now, you can trade in and out of these contracts before the expiry, no problem, but there is an expiry. With a perpetual future, there is no expiry. And this is essentially designed to track 1-for-1 the spot price forever, perpetually, right? And that means you can trade the spot price of the asset. You don't have to worry about an expiry or what will the price be at this point. The reason why you would trade in futures instead of spot is because you can take leverage, so you can trade with more than you have. It's also cheaper for trading fees, and also you can take short positions. So you can open a long, which is like buying, and you can open a short, which is like selling. Of course, we never actually exchange the asset, we're just putting cash down to fund trades. So there are advantages to perpetual futures and futures that you can go long and short, lower trading fees, use leverage, but with expiry date, you have an expiry date in the future. With perpetuals, it just goes on forever, there's no expiry date. Leading on from that, there's a massive difference between perpetuals and expiry date futures in the way that they're managed and what they're supposed to do. Expiry date futures simply have an expiry date, and it's up to the market to determine what that contract trades at. If the market's very bullish, the contract itself will trade much higher than the spot price. So the spot price could be 50,000. The expiry date future could be 80, 90, 100,000 because the market's very bullish and it just thinks the price is going to rise. If the market's bearish, it might be under that. It could be 25, 30, 40,000 under the spot price. It's up to the market. With perpetual futures, that is not what this contract is designed to do. With perps, because there's no expiry date, this contract is supposed to mimic 1-for-1 the underlying or real exchange rate for the asset that you're trading. So this is Bitcoin dollars. This really should mimic 1-for-1 the actual price of this currency pair. If it doesn't, then it's really quite a useless contract, right? Because if you're trading a contract that can completely fluctuate away from the underlying spot price, then you're not trading anything at that point. You thought you were trading Bitcoin dollars, the thing's going crazy, it's completely not in relation to the spot price, so that contract is untradeable at that point. So with perpetual futures, what the exchanges need to do is make sure that this contract, the price of it, stays exactly in line with the actual exchange rate of the two assets in the spot market. The way that they do that is through incentives to make sure that buyers and sellers are incentivized to push the price in a direction that is exactly the same as the spot price, so they move one for one. Basically, if the spot price of a perp, or if the futures price of a perp is too high in relation to the spot price, it's too expensive, right? So what the exchange does is it basically punishes people that are buying, pushing the price up with a funding rate. Think of it as like an interest rate. So if you're responsible for pushing the price up too high in relation to the spot price, they're going to punish you by making you pay a fee. Like, think of it as an interest rate to go long. And the reason here is that it's a punishment for you pushing the price up too high. And that fee that you have to pay as a buyer pushing the price up too high gets paid to the other side, to sellers. So you're a buyer here and you're paying a fee to the sellers on this side of the book. And that is designed as an incentive, not only to discourage you from buying, but also as a payment to sellers to come in and take the other side of the trade and get some yield from you. If the price of the contract is underneath the spot price, the price is too cheap, there's too many sellers, the exchange is going to step in and start to make the sellers pay money to the other side, right? So that's a fee to buyers, and it says, hey, if you're a buyer, you're now going to get paid this fee from sellers. Please come in and buy to move the price back up. So that's a funding rate. If you trade and you have open positions in the perpetuals or the perps market, this funding rate is something that you will either receive or have to pay depending on where the price is in relation to the underlying spot price. You can see it up here, see the funding rate. This can change over time dependent on supply and demand. But the whole point of this fee is to make sure that if the price is too high, buyers pay. If the price is too low, sellers pay, or shorts pay. And it's supposed to keep the price of the futures contract or the perps contract exactly in line with the actual underlying spot price. If you want to see me trade both perps and expiry date futures live and see how to enter trades, how to open long trades and short trades, and how to use leverage, I'll leave that for videos down in the description. It goes through step by step exactly what to do. If you want some deposit and trading bonuses on the exchanges I use, you can find those in the description as well. I'm James, it's moneyZG. Cheers for watching, and I'll see you in the next one.